It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
As the end of the year is fast approaching, what is your giving strategy to both optimize your tax planning and also optimize your estate planning? We're going to share our favorite strategies for both tax advantage, charitable giving, and family gifts. That and more on this episode of the Wise Money Show.
It's that time of year. It is that time of year. You don't need to be told that, but giving strategies. We're going to help you with it right now. If you have a question for the program, we'd love to hear from you. You can call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. Submit questions there as well. And then all over social media, wherever you're at, we are there as well. Search The Wise Money Show. That's right. So, I don't know. You know, it's end of year. Giving is on the mind. You're doing year-end giving. There's, the charities that you support and your church and all of that. They've had their campaigns. And so we're going to talk about wise strategies. But also it's the end of the year, which means it's almost the beginning of the year. And do you have the right giving strategy to set you up for the year ahead? Some of the strategies we're going to talk about right now, you're going to think, oh, I missed that one. I should have done it this year. Well, good news is you got another year right around the corner. So, and I know you're not doing gifts to get the tax benefit, but if there is a way for you to accomplish your giving goals and there's a tax advantage way to do it, it's stewardship. It's good stewardship to be aware of those and take advantage of it. Wise Money Show is a show about financial planning. There's 6 areas to your financial life. Giving strategy is not one of those 6, but it impacts almost all of them. Mm-hmm. So if you, go ahead, Josh.
Well, I was just going to say, I feel like there are way more people giving in the world than there are people planning their giving in the world. For a lot of people, it's just sort of what they do. It's just part of their rhythm and not something that they give a whole lot of thought to. Maybe something that you've never even talked to your certified financial planner about. It may not be worked into your overall financial plan at all. It's just kind of something that you do privately, and you maybe tell them about it at tax time or something, but how often do you bring this up? How often do you set goals or objectives around this very topic of giving? And I probably downplay this a bit in my mind as well. You brought up, Mike, this touches really all of the areas of your financial plan, right? Mm-hmm. And now I have an ongoing debate with my wife on whether there's 6 areas of your financial plan or is it really 7. She hears 7 every time we bring it up. But
just trust her; she's always right.
That's right. At least 99%.
And that is not an attempt at humor. She's right.
But your present financial position, that's your cash flow, and I mean, obviously a giving strategy is going to impact that. Of course, tax planning.
It's either cash flow, like are you going to give out of your ongoing cash flow and it affects just the ins and outs, or are you giving out of the accumulation of assets over time? Either way, that's touching your present financial position, right?
And I love where you're going there, Joshua, because that takes me back to yesterday, where we were doing a case class and we were working with this couple, and they had a pool of resources, and they had what they were doing with their own just financial life. And they depleted the pool of resources for lifestyle. And so they got through that pool of resources, and then they had various loans, car loans, house loans, fill in the blank. And they didn't have really anything to show for it. And so, because your question was, is there a plan for your giving? And this couple was very generous, which is awesome. It's just they couldn't afford to be that generous, because if me being that generous with my family along the way makes me have to work until I'm 70 instead of until I'm 62, that's okay if that's my choice.
Yeah.
I just need to know that that's the choice I'm making as I keep you on my cell phone bill, as I pay for your car insurance, as I'm always the one as the dad picking up the bill when we go out. As we do whatever, fill in the blank. So I love the idea that financial planning is just calling to people to be objective about, can I afford to do my giving strategy? And if I am, what are the trade-offs that I'm making by doing that? Because you might be giving thinking, there's no trade-off. I'm just doing the giving.
Yeah.
Woohoo! But
clarity and confidence, right? The clarity on where you stand and the confidence to know that you're giving and it all is fitting within your financial life. And then we're going to inject some creativity right now. Those are the three things that your CFP should be offering is what are some creative ways to accomplish your giving strategy. There's two sides to the giving strategy coin. One is to charity. The other is to family members. They're not the same. They are not the same. But let's share some of our favorite giving strategies. Let's start with when you're giving to charity, a not-for-profit 501c3.
This time of year, a lot of our clients reach out to us to help them facilitate gifts of investable assets that have accumulated a lot of gains. They've grown in value over the years. If you bought it cheap and it's worth a whole bunch of money right now, sometimes those are fantastic gifts to give to charity, because if you were to just cash those dollars in, sell the investment and pay taxes on the growth, or at least add it to your income, there's some sort of haircut that you're taking, right? Uncle Sam's going to get a piece of those proceeds. Whereas if you give the stock or give the mutual fund, give some sort of property to a charity and let them sell it and turn it into cash that they can use to sustain their ministry or their mission or whatever, they don't pay taxes, right? And so you're essentially cutting out some of the dollars that slip through the cracks in the form of taxes by just giving assets that have an IOU to the government attached to them, and that gets neutralized by giving it to a charity to cash in.
I think this is absolutely something you need to consider depending on the structure of your financial life, present financial position, your investment planning. Yep, it's hitting a lot of different areas of your financial life. But the thought of, well, I'm going to give some investments, some mutual funds, exchange traded funds, whatever, to the charity instead of just selling them myself and giving cash, I'm just going to say that is illogical. Most people, if you're not pausing or you don't have someone in your corner as your guide, you're not going to intuitively come up with that, because intuition is going to say they need cash. They don't need an investment. Why would I give them an investment? But it's just what Josh said. Either one of you, in either scenario, you're not going to hold the investment. You're either going to sell it and have to claim the capital gains on your tax return, or you can give the investment to the charity. They will sell it, and they will not have to pay tax on the capital gains. So I would much rather have you do that.
Yeah, and I would almost split my giving life into two different categories: before the donor advised fund and after the donor advised fund. Because in the olden days, if you wanted to give Apple shares to the church, you had a brokerage account. You had to make sure the church had a brokerage account. The shares needed to be DTC, technical stuff, but transferred to the church. The church then had to sell them. And then there was reporting that needed to come back to you saying you gave a number of shares on this date. The opening price was this, the closing price was this, but we sold it at this. And all of this complex tax reporting. And the new world is I take those Apple shares, which I'm holding in my Fidelity brokerage account, and I push them into my donor advised fund, and I sell them in my donor advised fund immediately. And I have the resources, and then I go directly from my donor advised fund and I push that money to my church. I can do it completely anonymously or completely, hey, this is me, I'm giving this money. And you say, well, how would you decide? If you're in a small church and you're giving a disproportionate amount of money, you probably want to remain anonymous. If you've signed up for some charitable giving or made a pledge and you need kind of credit for your pledge fulfillment, you might want to let them know, hey, this is me giving the money. Mm-hmm.
Yeah, that donor advised fund is definitely a tool that you need to be talking about with your certified financial planner. If that's not on your radar, if you are charitably inclined, and especially if you have assets that have grown in value, this is one of the ways to handle some some of the logistics of giving to the charity in a way that can benefit you and them the very most.
Yeah, so mixing two different ideas there, because they often do go together. If you have highly appreciated non-retirement investments, giving those dollars to the charity, oftentimes it's going to be easy to do that during using a donor-advised fund. We're going to unpack those strategies a little bit more and share some more. We got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time. Also on a podcast at the same time every Saturday morning, but also on a couple local radio stations at the same time, which is why the content's structured the way that it is, with segments and breaks and as long as it is. But we've got Next Wise Step videos that air all throughout the work week, taking one financial concept, applying it directly to your financial life, 8, 10, 12 minutes long, something like that. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. And if you like the content, appreciate it. Okay. I said unpack. I was trying to avoid it, but my brain, I couldn't. There was no detour. I just had to say it. Sorry, Kevin.
Oh, I didn't even catch it. I am so
snuck that one by the goalie.
Distracted. I've actually distracted myself. So I think the more I think about it, these charities need to be going to all their donors and saying, listen, if you've given money to us, please give through a donor advised fund. And I'm tempted to not make this just bonus content. I'm tempted to say on the...
Let's do it then. Don't be tempted.
And I want to come back to that highly appreciated stock one,
yep.
too.
Let's go.
And I've got a little... the
little add-on to the add-on.
Well, the little mistake that was the party's show remain nameless to protect the guilty.
All right, here we go. What are your year-end giving strategies? Are they, founded and grounded in clarity and confidence on where your giving fits within your entire financial plan and your financial goals? And do you have the right level of creativity so that you're getting any appropriate tax savings or doing it in a tax-advantaged way? That's what we're helping with right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. Then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Okay, so we're starting with the giving to charity side of the giving strategy. We'll get to if you are making gifts to family members. But guys, we left off on two things that, gosh, there's a lot of depth there. Mm-hmm. And that is giving highly appreciated stock and then also using a donor advised fund. Oftentimes you're going to do those things together. You may not, but there's more to hit there.
Yeah, absolutely. I'm thinking of a client who, it's this time of year, every year we're having a conversation about what types of assets does she want to give to a number of charitable organizations that she just really cares about and wants to support. And the strategy that we're using is, yes, using a donor advised fund as we left off in the last segment. But I also want to emphasize in her particular situation, her husband passed away years ago, and he was really a very successful investor. He picked a lot of individual stocks, and she still holds many of them today because they have run up in value so much that if she were to go in and just make some wholesale changes with her portfolio, she would just get clobbered with taxes, right? So there's a lot of investments that are highly appreciated investments, as we would say. They've grown in value significantly. And those are some of the best candidates to be gifting to these charities. But we don't, as Kevin was saying in the last segment, we don't want to send a few shares off to this church and a few shares to that missions organization and over here to this school or whatever. Instead, she gifts these shares to her donor advised fund, and then they get liquidated. And then she has the ability to direct the donor advised fund to send the cash when and where she wants to. But here's the point that I wanted to make, because we started the show talking about how your gifting strategy really needs to be a financial planning game plan, right? It needs to touch all areas of your financial life, or at least be influenced by these. And in her situation, we over time, much of the selection of which stocks are we going to give, it has to do with us shaping and molding and rebalancing the investment portfolio, right? So this is as much an investment decision as it is a giving decision or a cash flow decision or a tax decision, because we're trying to use the gifts almost as a way to rebalance the portfolio. We're giving some of the most highly appreciated stuff that has grown to such a large size in her portfolio that it actually represents quite a bit of risk.
Yeah.
One company's stock falling in value all of a sudden affects her bigger than ever before. And so taking some of those really strong growth assets that may or may not have a strong growth trajectory moving forward and gifting those, it's one of the ways that your investment decisions have an impact on your giving.
Well, but I want to make sure we don't miss one point here. If you're listening to all of that story and saying, well, I could do that, but I don't want to give up my shares of this. I've got the cash. I'm just going to, I don't want to, it sounds like you guys are talking about giving stocks and just giving away my wealth. No, I need my wealth for my retirement and legacy and so on. I've got cash to give. I'm just going to give that instead. No. Give the highly appreciated stock and then use the cash to buy back the same number of shares of that same investment that you love. Why? You just bought up your cost basis. Sorry for the geeky speak there, but that you just basically now own the same investment with the same upside potential, but now your cost basis or your future potential gain is now much better because you gifted away a whole bunch of capital gains and used your dollars to repurchase those shares. That is not, you might have heard of something called a wash sale, those sorts of things. Nope, that's not a wash sale. That's a completely legitimate financial strategy and one that you should consider.
Yeah, it's a profoundly simple concept, but when you peel back the onion a few layers, it can be complex in the execution of. And if you're listening to this and you're saying, well, listen, I don't have any highly appreciated stock, so I can switch over to the 80s music station here right now, I'd say stay tuned, because you should, if you're giving, say, pretend you're giving $6,000 a year to your church, and you say, well, I'm just doing it automatically. Well, if you're doing it automatically, it's likely that your church could be taking a 2 to 3% haircut on that money, depending on how you're doing it. It might not, but it could be. And so I would encourage you to say, hey, if you have the funds, put the $6,000 in your donor advised fund and then send it directly to, you can do an ETF directly to your church's bank account. And you say, well, what's the benefit of that? There's two benefits.
EFT.
Electronic funds transfer.
Yeah, that's what I said. Rewind the tape.
I know.
So,
I mix those up all the time.
Yeah. So, anyways, so if you're giving to the WNBA or the NBC or the MSNBC, whatever you're giving to, you want to you want to simplify it for that organization. How do you simplify it for that organization? If you put the money in your donor advised fund, you're going to have one receipt from your donor advised fund. If you give to your church or a number of different charities, you're going to have to wait in January for receipts from these various organizations. What if you get a chunk of money at the end of the year that you want to give, but you're not exactly sure who to give it to and you don't want to be rushed? You put it in your donor advised fund. When it crosses the threshold into your donor advised fund, that's when you get the credit. And then you can give it over time. I've seen folks that have had events where they had significant funds that they wanted to give, and they said, if I give these funds at one time, it's going to wreck things for this organization. So I'd like to give these funds over time. How do you do it? Well, you want to match the deduction, the reduction in how much taxes you're going to pay in the year of the event. Mm-hmm. So you put it in the donor advised fund, bam. But there are all kinds of benefits to the donor advised fund that I'm probably not doing a great job of explaining based on your smirks.
No,
boys.
Who was the chef, Emerald?
Bam.
Yeah. Put it in your donor advised fund. Bam.
That's what happens.
But yes, you get the it's a completed gift in the eyes of the IRS when the money goes into the donor advised fund.
Yes.
And because of how high the standard deduction is, if you've got a chunk of dollars that you want to get the benefit for on your taxes, but you don't want to disperse all those dollars to the charity at one time, throwing all those dollars into the donor advised fund at one time gives you that higher completed gift.
That's right. I actually just had that conversation last night with a client who, in a typical year, we just looked back on history, they were giving about $14,000 a year to their local church primarily,
yes.
and others. It was just enough. When you count their charitable giving of $14,000 plus some mortgage interest and some of their state and local taxes, real estate taxes, all those things that get added up to build an itemized deduction, as we call it, your tax write-off, I often call it by slang. It's never enough to get up to the freebie that the government is giving you as a standard deduction. So they're always really, really close, but never quite there. And so I kind of broke the news to him that, listen, you aren't giving any tax benefit to the gifts that you're giving, and I realize that that's not the reason you're giving. But he had heard about this idea of giving in chunks every other year. And so I helped him unpack that strategy. And it's essentially, if you had the cash flow, if you have the cash laying around to be able to pull this off, you could give this year's gift here in 2024 and next year's gift, 2025, put both of those contributions into your donor advised fund. And now you've essentially doubled up. Right? You've gotten enough contributions instead of $14,000 showing up on your tax return and not being quite enough to help you on your taxes. Now it's $28,000 and it very much is helping you.
Yeah.
And in doing so, you just took 2 years that neither were going to be helpful to you on your taxes. You made one of them very helpful. And then the following year is back to kind of normal as it would have been. No harm, no foul, no change.
Yeah. Now, one of the prerequisites to this donor advised fund idea or this giving highly appreciated stock is that you have investments or cash or resources outside of your tax shelters, outside of your 401k, your IRA, your Roth IRA. What if you've been listening to this saying, well, wait a second, can I give my retirement dollars? Does that work? There actually is a strategy. We're going to share that and more coming up on the Wise Money Show with Korhorn Financial Group.
Did I say unpack there?
You did? I got it.
Did?
Yep.
Did you catch that?
No. No.
Maybe we've cured him.
No,
No.
I'm too. I've gone internal. There are so many things I want to say, and we're not getting really where you want to go. But I do want to talk about the one mistake.
We'll do that. Just curious, what temperature is it in here? Because I feel like my lower lip is like, my jaw is shaking.
Well, here's my question.
I tried to talk, and it's just so cold.
Did you do the cold plunge?
I didn't.
Okay. Well,
But I feel like I'm in it at the moment.
the issue with the air temperature is it's like 24 times more powerful to sit in the water in the cold plunge than it is to. I did my cold plunge in the Dowagiac River this past weekend.
Whoa.
It was fabulous and awful at the same time. But yeah, so Mike, I don't know. I'm sweating.
Crazy.
I might be pre-menopausal. I don't know what's going on here, but
And yeah, I'm all over the place temperature wise because I think I might be getting sick. But
well, and you guys have you guys are geared up for this cold weather.
I might grab more gear.
Well,
some mittens and earmuffs.
It is. Your lips are purple.
What if?
But it is. So it's December 21st, and I was
14th.
Whatever it is of 2022, and I'm thinking that at some point here it might be snowing in the studio, which would be fitting for.
Nice.
So, can I read this
third segment?
just a little bonus content. So the author of the bestseller Catcher in the Rye, J.D. Salinger, is at a fancy party in New York City. He's talking to a friend when a magnet passes by. Magnate. His friend says to him, J.D., that guy who just passed makes more money in a year than you've ever made with your book. J.D. wrote Catcher in the Rye, right? To which Mr. Salinger replies, but I have something he does not have. What is that? Asked the friend. Enough, says J.D. Salinger. And that is because what we're talking about may not make sense depending on what your vision for the wealth that you have. some people, and this is not a critique, it's not a criticism. I think when you look at the internal finance, the only thing that makes sense is to keep piling.
Yeah, more.
Because that can be rooted from childhood experiences with money. It could be rooted from a bankruptcy. It could be rooted from all different types of things. This is why if you can work with your certified financial planner to know what enough is, then you have the freedom to do this.
Yeah.
And it's, I have a giving strategy, or when I die and I assume room temperature, there are 3 checks cut and the kids each get a check. Is that what they want? I don't think, especially this generation of kids. Like, they want to do stuff. They want experiences. They want to do stuff. Well, do we have the money to do it? Mm-hmm. And that's where objectively you have to know for sure, what is that budget? What's the giving budget? What's the experience budget? What's the family trip budget? Fill in the blank. So anyways, I love that quote though.
Yeah, that didn't need to be bonus content. That's like
that
show stuff.
And
that's
fits
good.
right in line with some of the stuff that we've heard and researched and experienced this year. Arthur Brooks stuff and
Yeah.
right? And Morgan Housel. And, all right, here we go.
That's
Third segment. We'll pick it back up. I'm assuming at some point in this segment we'll pivot to gifts to family members. We'll see.
Oh, that'd be where the mistake comes from.
Oh, okay, great. All right, here we go. We've been talking about giving strategies, and we've sort of camped out on giving from your investments. Well, what if all of your investments are in tax shelters? Can you gift from those? Is there a strategy? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there, follow us there, and rate the program there as well. We appreciate it. It's giving season, really, and whether that's year-end gifts, or this is just normally when you make your gifts, or if you're planning ahead for next year. What's my giving strategy? Oh, we give every week to the church. Well, are you doing it in the most advantageous way, tax-advantaged way? We're sharing some ideas. We've been talking about the donor advised fund and giving, whether cash to it or highly appreciated stock. And most of you should have a tax-sheltered strategy. All of you should, where you're funding your 401k, funding your Roth, and so on. And you're sort of left out of that discussion. Because if you don't have any highly appreciated stock outside of your retirement accounts, it's only going to be cash that goes into the donor advised fund, which is great. There's still lots of benefits for that. But there is a strategy, a unique strategy for giving investments from a tax shelter directly to the charity and having it benefit you on your taxes. Now, there's limitations to it. So it doesn't apply to everyone. But when it applies to you, I would argue, guys, this is one of the most underutilized tax strategies out there. Josh, you said at the beginning of the show, there's far more people giving than those that have a giving strategy. Mm-hmm. I would say there's far more people giving from their investments indirectly than are doing it the wise way using what's called a qualified charitable distribution.
Yeah, I mean, you think about how many people have gotten to retirement. They have significant assets in some sort of a tax shelter. Let's just use an IRA as an example. And when you're in retirement, you start drawing off of that account, right? In fact, you will eventually get to an age where they make you start pulling out of that account because they want to force you to kind of count it as income on your tax return. But if you are just drawing off of your IRA, counting that distribution as income, paying some portion of it in the form of taxes each year, and then with the proceeds, living life, and part of living life for you is giving to a charity. If every month or every week you're giving to your local church, for example, you're essentially giving money that you have, in a roundabout way, pulled out of your IRA, counted as income, paid taxes on it, and then given a gift to the local charity or your church or whatever. And you've done it with after-tax dollars that you are hoping to maybe get a tax break on potentially. But almost no one does, because most people are accepting now a standard deduction on their tax return instead of an itemized deduction. And so essentially you're getting the downside of pulling money out of the IRA and giving it to the charity without the upside, without the potential or the benefits. And so the better way is to skip the in-between stuff. Even if you don't realize that there is an in-between happening, when you pull money out of your IRA and send it straight to the charity, if you're over age 70 and a half, you can count that as a qualified charitable distribution, or a QCD as we often call it. And a qualified charitable distribution benefits the charity the exact same way. They get the same cash. They just get it directly, but it benefits you as well because you don't have to count that as a distribution or as income on the tax return. It satisfies things like your required minimum distribution, some of the rules that exist around being an IRA owner out there in your 70s, but it doesn't hit you with income. So in other words, you're not paying tax on the money before you give it to the church.
So instead of claiming it as income and then trying to get a tax benefit, it's just not income. Now, the thing is, it's not until after age 70 and a half. And so you are very much set in your ways, and that's why I would say this is so underutilized, because you just already have your system. You've been doing this for a long time, but now there's this potential tax benefit. So pausing, getting clarity and confidence, and this applying this creativity can save you a lot of tax. All right, let's flip the coin now, and we can go back if we need to, but let's flip over to giving strategies, but not to charities, to just what feels like charity, and that is family members. So this is, it's holiday season. So whether you're making, a cash gift to the kids, instead of having them receive a bigger inheritance out there in the future when you're gone, giving them some cash, helping them enjoy some experiences today, watching them enjoy it, and or whether that's to grandkids. What are some of the wise strategies there?
Well, one of my favorite things I've heard recently was we were doing a show on the Roth IRA, and Joshua was talking about the income limits to contributing to a Roth IRA, and how you can actually contribute to a Roth IRA down the bloodlines, and on behalf of your kids. If you have kids that don't have the resources to contribute to a Roth IRA, you can put that money in there for them as long as they have earned income. So there are some great giving strategies, and because we don't know exactly where things are going to fall with what the federal estate tax limits are and whatnot, it makes sense for some folks to begin giving to their children while they can work with the children and not change their lifestyle dramatically. Because I was talking with a client, and they had 2 children, and we said, well, what would happen are they prepared to each, if you both died, are your children each prepared to receive $10 million? And they said, no one's prepared to receive $10 million. Yeah. And I thought, well, that they're probably right. And so if you're not prepared, what would you do? And so I would say, well, if you're not prepared, get started. Yeah. Do a dress rehearsal. Hey, there's this, what I would call the world's greatest child tax credit, in that I can give $18,000 this year. I can give $19,000 next year. I can give it to my kids. And if my wife and I have a child that's married with 2 kids, I can give 4 times 18, and she can give 4 times 18. So we can give $144,000 to the children. Now, if you're listening to this and you say, well, that doesn't make any sense, it might not make any sense to you. It makes sense to people that have a net worth of $20, $30, $40 million, because that really doesn't even take the edge off the growth on that money. But it's a way to give, and if you're doing things for the children, such as helping them fund 529s, fund HSAs, 401ks, things like this, you're giving them money and not really changing their lifestyle dramatically, but getting them used to having more money, and that doesn't change their lifestyle.
Yeah, money that they need to make some decisions with. And make some prudent investments with, that kind of thing. It just gives them practice, if nothing else. And I mean, essentially, the group that you're talking about, there are plenty of folks out there. All three of us work with people who are either receiving these types of annual gifts from their parents or grandparents, or they are making these types of gifts to family members. And pretty much universally across the board, it's an example of someone who they have they've done the math, they've done the planning, they recognize we have more than enough in our financial life. We have enough to fund our retirement, to live out our days and fulfill the vision that we had for our future. It's here now. We're doing it. And there's still going to be some left over. The question then is, if there is more than enough, is there something you could be doing with that money to get it into the hands of the next generation, as you said, Kevin, so that they can get some practice, so that they can be ready if it turns out that there's even more than leftovers, more than you realize? If that's the case, can you give it to them during your lifetime and while it's at a point in their lifetime that it can be the most helpful to them? You know, when it's the college years and cash is tight, when there are weddings on the horizon or just major expenses, is there something that you could be doing because you have more than enough to shift those assets now while it can have a bigger impact?
You know, Kevin, you did the math on it's called gift splitting, and it's the annual gift exclusion, 18,000, so moving to 19,000 here in just a couple of weeks. But I guess that's the point. If you are someone that you're looking at, I could be giving a lot to the next generation or the next generations, you can do a little bit right now before the end of the year. Gifts are completed by 12/31, and then you can do a little bit more in January, right? You can actually, in 1 month, you can actually cover your bases on 2 different calendar years and shelter a lot of dollars from the estate taxes or whatever and give to the next generation. All right, we've got more coming up here on the Wise Money Show with Korhorn Financial Group. All right, pivot to listener questions. A couple of things that we didn't.
Okay, so can I? All right,
you got to hit this mistake.
Well, I don't, you tell me or not. I'll just give it. The mistake was there was an assumption with the children. We were giving appreciated stock, and the assumption was none of the children would pay capital gains tax on that. And one of the couples surprised everyone to the upside, and so their taxes, they owed tax. And they were upset about it. And you think, well, oh, come on. How would someone who was given a gift be upset? Well, it was a missed expectation. It was a mistake. And their advisor, who shall remain nameless, didn't do a good job of setting expectations for the parents, who then could turn around and set good expectations for the children. There was still less tax paid at the kids' capital gains rate than the parents would have paid at theirs, but it felt that wasn't much of a consolation prize when the children were expecting to sell it and pay no tax.
Well, that's the only thing that I had on my list that we hadn't talked about is when you're giving to family members, you can give highly appreciated stock as well. Just know that you're giving the tax consequence with it. Yeah. And is that worth mentioning? I don't think that's a full segment.
No, but I think you mentioned that and then pivot into listener questions.
Okay, I've got a couple highlighted. You don't even need to see them.
No,
you're ready. So, all right, here we go. 4th segment. Land on the plane. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode, as well as a lot of other content, is on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show. Subscribe to it there. And turn on notifications. You're made aware every time we drop new content. Not only is this talk show and every talk show there, but all throughout the work week, we've got Next Wise Step videos, 8 minutes long, 10 minutes long, 12 minutes long, taking different financial concepts, applying it to your financial life from a financial planning perspective. And that's why it's Next Wise Step, helping you take your next wise step in your financial life. So make sure you go to YouTube, search the Wise Money Show, subscribe to it there, turn on notifications. You can share content easily. You can leave questions there as well. We appreciate it. All right, so we're just wrapping up the discussion on your giving strategy. Then we're going to hit a couple of questions from fans of the show. When we're talking about gifts to charities, we were talking a lot about giving appreciated stock, because instead of you selling the stock and having to claim the capital gain, give it to the charity. Charity will sell the stock or put it into your donor advised fund, then sell the stock. When you do that, no one's paying the gain on it, and they receive the resources. You can give highly appreciated stock to other family members as well, instead of just cash, and many times that's going to make a lot of sense. But know that when you make a gift of an appreciated asset, whether that's investments, whether that's a property, your house, you're giving the tax responsibilities along with it. So say, for example, you bought, and this is a common one that's not often linked to year-end giving, but you bought your house for $150,000. And you are concerned as you're getting older and into retirement, what might happen? I should get this out of my name. That we hear this all the time, not in relation to a giving strategy, but just more of a fear. Mm-hmm. I don't want something to happen to my house. Let me give it to the kids. Well, if you bought it for $150 and it's now worth $300, when you are giving it to your kids, now you're giving that tax responsibility as well. They're not going to, their quote unquote cost basis isn't $300,000, it's still $150. Mm-hmm. And because whenever they sell it, they never lived in the house, they're going to have to pay the capital gains on that. Versus if you keep the house and the kids inherit it when you pass away, there's a step up in cost basis, that capital gain goes away. Or if you say, well, nope, it's time to sell the house, there's a home gain exclusion that you would avoid taxes on that. I know that's an extreme example, but just illustrates there might be many reasons to give stock or give assets to the kids as part of a giving strategy. Just know that you're giving the tax consequences with it.
That's exactly right, because in the scenario that you were just painting, if the mom or dad sold the house themselves, there would be no tax, because it's their primary residence and they'd lived in it presumably for more than 2 out of 5 years. So the tax is eliminated. If they passed away and left it to you as their child and it was an inheritance, Mike, you were talking about how the tax bill gets wiped clean in that scenario as well because of this step up in cost basis. The third option of giving it to the kids, unfortunately, it's the worst scenario from a tax standpoint. And so it may have some lifestyle reasons, there may be some other planning reasons to do it, but just stop and recognize giving is a very important part of your overall financial plan, and you need to be looking at it through all the same lenses that you normally would in all the other decisions that you make in your financial life. Mm-hmm. And so that's why it should be a conversation that you're having with your certified financial planner. They should be helping you just think through what are all of the ramifications, especially from a tax standpoint, before you pull the trigger on these ideas.
Yeah. Yep. And no, if you're giving appreciated stock to another family member because they're in a lower tax bracket than you, that may make a lot of sense. Just make sure you're setting the expectation that when they sell it, they're going to have to pay the tax on it. They're going to have to report the capital gain. It may make a lot of sense. It may be the wise thing to do. Just setting the right expectations can help manage some frustrations. So, all right. Okay. Work with your certified financial planner. Make sure you've got a giving strategy. You're not giving for tax benefits, but if there are tax benefits out there and there's just a slight adjustment that you can make in the approach that you take to your givings, that's being a good steward. So work with your CFP on that. Let's pivot over to some questions from fans of the show, get a little diversification in the content here. This one comes from a while back, but friend of the show, Roberto, emailed in and said he's a retired federal law enforcement employee, and he's receiving a pension. When we talk about funding 401ks, funding Roth IRAs in particular, is the pension considered part of the earnings test?
Seems like it should be, huh? Because it's coming essentially from a former employer or a fund that they created for you, but it's more like Social Security in that, yes, this is income to you. Yes, you're going to count it on your tax return, but it's not considered wages or earned income like from a side hustle or a small business that you have. And so it doesn't qualify you to make things like IRA contributions, Roth contributions, that sort of thing. Those types of of retirement plans can only be funded if you have essentially wage income, or I always call it paycheck money.
Yep.
That's what qualifies you to be able to be able to fund those each year.
There's a couple angles here to the earnings test, and Roberto didn't expand on. Here's the exact question, but right, that's not earned income. It's not paycheck money, as Josh often says. So that doesn't qualify you to be able to contribute to a Roth IRA or something like that. But the other side of the earnings test is, well, I'm drawing Social Security. I'm retired. I'm going to turn on Social Security. Does my pension count as wages and now could push me above I'm drawing Social Security before my full retirement age? Is this going to cause my Social Security to be penalized if it's too much?
Another great question, right? And what you're referring to is the fact that if you start drawing Social Security before your full retirement age, which is it's a different age for everybody depending on what year you were born in. But if you're starting it early, then first of all, you have had a haircut to the amount of benefits that you're going to receive. You're accepting a discounted amount for the rest of your life. But you also, until you reach that full retirement age, there's going to be a calculation that's done every year on your paycheck money, your wages. And if you earn more than the government's threshold, then it can start to have an impact further on how much Social Security you're going to get in that given year. And the good news is that pension income it doesn't get treated as paycheck money or wages or earned income. And so it doesn't give you that haircut on your Social Security benefits.
Before your full retirement age, this calculation needs to be done. And how much are you allowed to earn if you're working part-time or whatnot? Yeah, it's complicated. It depends on a few different variables. Think, around $1,800 a month, but that is not approximate, or that is approximate. That's not exact, okay? But that's wages, and that's only up until your full retirement age. For many people, that's age 67. A pension does not count for that. That's for penalizing your Social Security. But there's and it feels like a penalty, but there's a different thinking or a different calculation done for whether your Social Security is going to be taxable. And this pension income very much is going to be included in that calculation of, is your Social Security taxable?
Yeah, and we had a fun conversation about that yesterday in case class. I think case class is my favorite time of the week. But we were talking about what are the different types of income. And one of the newer advisors was grabbing for it and said normal income. And so it was a great shot. We would say ordinary income. So there's ordinary income. That's money that I earned. I refuse to say what Josh says. But it's money that I earned. It's wage. It's W-2 income, right?
Paycheck money.
There you go. I
There
cannot
you
believe
go.
you just did that to me.
Yep.
But there's also passive income. And there's also capital gains. We were talking about how is money from an insurance contract, how is gains from an insurance contract taxed? Is it capital gains or is it ordinary income? And so there are all kinds of different types of income that impact your tax situation differently, which is why you want to be doing tax planning. Yeah. So hey, if I make this decision over here, if I move this lever, what other 3 levers get moved without me realizing it?
Yeah. And how do you do that? Yep. That's tax planning is one of the 6 areas of your financial life. But within tax planning, that you need that proactive tax projection. Whether that's proactive this year, which we're running out of real estate here, but looking at, where do I think the tax return is going to land when I get all my forms in the spring? But also, it's a couple years out as well, projecting what do I think my tax picture is going to look like. So, all right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.